The world is more connected than ever, and for American companies the market is now global. It's not just giants like Apple. Small and medium businesses are expanding internationally too. Why? Growth. When domestic markets are saturated, the next step is to look abroad for new customers. International markets offer billions of potential buyers, an opportunity too big to ignore. Efficiency is another driver. Companies source materials or set up operations where it's most cost-effective, building resilient supply chains. This isn't just about cutting costs, it's about staying competitive. Going global also spreads risk. If one market falters, others can keep the business afloat. Plus, international expansion exposes companies to new ideas and practices, fueling innovation. The result? A cycle of improvement that strengthens the entire organization. In short, American businesses are looking abroad for growth, efficiency, risk management, and knowledge. The global economy rewards those who adapt and seize these opportunities. The question isn't if you should think globally, it's how. Let's explore how companies measure and bridge the gap between markets. Success abroad isn't guaranteed. What works in Ohio might flop in Oman. Enter the CAGE framework: cultural, administrative, geographic, and economic distance. It's not about miles, it's about the real gaps that can make or break a venture. Cultural distance, language, values, and customs shape what people buy and how they do business. Smart companies adapt products and marketing to fit local cultures. Administrative distance, shared laws, trade agreements, and political ties can smooth the way or create barriers. Doing business in Canada is easier for a US firm than in a country with different rules and unstable politics. Geographic distance, physical separation, time zones, and infrastructure affect costs and logistics. Economic distance. Wealth and income levels determine what products will sell. A luxury car might thrive in Switzerland, but affordable smartphones could explode in developing markets. The CAGE framework helps companies assess challenges and tailor their approach. Understanding these distances is the first step to global success. Next, let's look at the strategies companies use to compete internationally. How do they choose the right path? Once companies understand the CAGE distances, they need a strategy. There are three main approaches: multi-domestic, global, and arbitrage. Multi-domestic: think local, act local. Products and marketing are tailored for each country. Example: Nestle sells different foods in Europe and Asia, adapting to local tastes. This approach wins where cultural differences matter, but it's costly. Global: one product, one brand everywhere. Efficiency and consistency are key. Think Rolex or Intel: universal appeal, massive economies of scale. But a one-size-fits-all approach can miss local nuances. Arbitrage: exploit differences between markets. Design in the US, source in Brazil, manufacture in Vietnam, sell in Europe. Each step happens where it's most efficient. This strategy builds a global value chain but requires complex coordination. The right strategy depends on your industry, strengths, and the distances you face. Choose wisely. Your global success depends on it. Now, how do companies actually enter new markets? With a strategy set, the next step is choosing how to enter a new market. 4 common methods: exporting, licensing, franchising, alliances, joint ventures, and wholly owned subsidiaries. Exporting: make products at home, sell abroad. Low investment, but less control and potential tariff costs. Licensing, franchising: let a local firm use your product or brand for a fee. Fast expansion, but you risk your reputation. Alliances, joint ventures: partner with a local company to share risks and expertise. Great for accessing local knowledge but requires trust. Wholly owned subsidiary: build or buy your own facility abroad. Maximum control, but highest cost and risk. Large, experienced firms often choose this for tight control. The right entry mode balances risk, control, and investment. There's no one-size-fits-all answer. Each company must match its goals and resources to the market. The method you choose shapes your global journey. Next, what does all this mean for future business leaders? How can you prepare for a global career? Let's wrap up with a call to action. The world is waiting. Are you ready? We've covered why American businesses go global, how they measure market differences, choose strategies, and enter new countries. International business is complex. Success comes from planning, understanding, and smart execution. These aren't just theories, they're real tools leaders use to make critical decisions. As a future manager, global thinking will be essential. The line between domestic and international business is fading fast. Understanding these principles will set you apart and open new opportunities. Dive deeper, study real-world successes and failures, debate strategies, Analyze the cage framework in action. The more you learn, the better prepared you'll be to lead in a global economy. The world is your marketplace. Get ready to make your mark. Please subscribe, comment, and follow the channel.